Are you thinking about selling everything? Stop. In the next few minutes, I'm going to show you why panicking is the worst decision you can make and how these moments of fear are exactly where the best opportunities are hiding. Global markets are dropping because of renewed trade tensions, and global debt is at an all-time high. But at the same time, central banks are buying gold like never before. What did they know that we don't? Stick around to find out. Let's get straight to it. The market is scared. Renewed tariffs on Chinese imports have triggered a wave of selling. And what do most people do when they see red on the screen? They sell. This is the biggest mistake an investor can make. You don't make rational decisions when you're afraid. You make emotional ones. The time to sell is during periods of extreme optimism and high valuations, which is why I sold some positions in Tesla or Netflix in the past. The time to buy is now, during the fear. Good companies bought at good prices should be held for the long term. This downturn is creating those good prices. You have to be prepared to hunt for opportunities. If this rational approach to investing makes sense to you, hit that subscribe button right now so you don't miss these opportunities when they appear. So, where are the opportunities? Let's start with companies that have been hit hard. Look at PayPal. The drop has been brutal, and it's now trading at very low multiples, below 13 times earnings. The market is pricing it as if it will never grow again. This is the kind of irrational selling I love to see. Then we have the Chinese tech giants, Alibaba and Baidu. After a recent rally, they're back at reasonable prices. These are leaders in artificial intelligence with solid businesses. They aren't just search engines or e-commerce sites anymore. They are the future of AI in the region. Let's talk about semiconductors. Qualcomm fell 7%. It's now at a much better price than many of its peers, trading at a forward PE below its historical median. With strong expectations in automotive and smartphone chips, it's a very attractive idea. Others on my radar include Mercado Libre, the Amazon of Latin America, whose growth potential is massive. Anta Sports, a leader in China, is also back to attractive valuations. And even Amazon itself is starting to approach prices that look reasonable again. But beyond individual stocks, we need to look at the big picture, and that leads me to gold. Gold is in a corrective phase, not a market top. After 6 consecutive weeks of gains, a pullback is completely normal. The fundamentals are stronger than ever. Governments are spending like there's no tomorrow, liquidity is increasing, and central banks are buying gold aggressively. This provides a solid floor for the price. Later, I'll tell you the sneaky reason governments might actually want the price of gold to go up. Now for Bitcoin. It's also in a correction. We are seeing aggressive selling from whales, but here's the key. Institutions like BlackRock and Fidelity are quietly absorbing all that supply. I'm still impatient for it to start rising, and I think it could fall a bit more before it finds a bottom, but this institutional buying is a massive long-term bullish signal. Remember I mentioned governments might want gold to go up? Here's why. Global public debt is at a historical peak. It's not just 1 or 2 countries, almost every major economy is drowning in debt, and there is zero political will to cut spending or raise taxes. So how do they manage it? A rising gold and Bitcoin price devalues their currency, making their debt cheaper to pay back. It's a silent default. This is why we can't just chase returns in a few hot tech stocks. Recessions and major corrections are inevitable. Ray Dalio always says diversification is the only free lunch in the markets, and he's right. The US market is dangerously concentrated in AI-related tech stocks. We need to rebalance our risk. This doesn't mean selling all your US stocks, but it does mean building a more resilient portfolio. Look at international stocks, which are trading at a discount. In Europe, Germany is stimulating its economy with massive investment in defense and infrastructure. In Asia, corporate governance reforms in Japan and South Korea are unlocking huge value for shareholders. And don't forget about bonds. For the first time in years, they are once again an attractive defensive asset, offering attractive real yields. I prefer short-term bonds from 2 to 5 years to avoid the risk of long-term inflation. Your goal should be to build a resilient portfolio that can survive any storm, not just one that performs well when the sun is shining. So, to recap, don't panic. Fear creates opportunity. Look for unfairly punished, fundamentally strong companies. And, most importantly, build a diversified, resilient portfolio with exposure to international markets, bonds, and hard assets like gold. If you got any value from this analysis, please subscribe to the channel. It's the best way to support this work. Now I want to hear from you. What are you buying in this downturn? Let me know in the comments below.